Good evening. We're here today at the UCL with Anton Kreil, ex-Goldman Sachs, Lehman Brothers and JP Morgan trader. At present, he's the managing director of the Institute of Trading and Portfolio Management. And tonight, he'll give us an overview of what it means to work in the industry, in particular in investment banking, hedge funds, and what your career developments and opportunities are. It's a very important speech. It'll really open your eyes in terms of what you can expect. Please give us a warm welcome to Anton.
Okay, fantastic. We're ready to go. So, you're probably wondering why I'm here this evening. Well, it's really to deliver a message that you won't get told by people who come to your university who are pitching you essentially to go and work for corporates. So you probably get a lot of investment banks, accountancy companies, finance companies, maybe private equity companies coming in, and they're basically advertising their own companies and telling you guys or asking you guys to come and work for them. So advertising internships, graduate positions. The problem is these guys are actually delivering you a corporate PR message that's been given to them, and they've been told what to say. They tell you all the good stuff. What they don't tell you is the truth. They don't tell you the good stuff and the bad stuff. And if you guys are spending a lot of money on your degree and you're applying to these places to go on internships, graduate training programs, you need to know what you're dealing with, what you're applying to. Otherwise, you're just going in blind. So today, what I'm going to do is actually tell you all the good stuff and the bad stuff, i.e. the stuff they will never ever tell you. And the stuff you're going to be shown today can literally take you 10 years to work out. So it can really, really give you a fast forward in your career if you understand all of these things and how they work and how you can operate in the industry and be successful by actually dodging all the bad stuff and only getting the good stuff. Does that sound good? Right. First thing we're going to do, so this is the schedule for this evening. First thing we're going to do is we're going to navigate the landscape. So we're going to be looking at the trading and portfolio management industry and what professional traders actually do and operate in that industry. We're going to move on to their real functions. So I'm going to deliver you the truth on what these guys actually do day in, day out. You guys have a perception of what professional traders do. Unfortunately, it's extremely misguided. We're going to be looking at all those reasons why as well. But we'll be looking at the realities and the functions of professional traders. We'll be also looking at the compensation. So what these people actually get paid. There's different types of professional traders. Some get paid very well, some get paid terribly. In fact, the vast majority don't get paid well at all. But when corporates come to deliver you their message, everything's rosy, everything's sweet. They don't tell you what the numbers are 3, 4, 5, 10 years down the road and what you actually have to deal with. So we'll be looking at the realities of what they do and what they get paid. What we'll also look at is typical career progression. So a career progression over 10 years of somebody who walks into the investment banking industry now, or the hedge fund industry. So guys like yourself who are going to be working in the next couple of years, starting in those industries. What's the next 10 years going to look like? Then we're actually going to formalize opportunity cost. We're actually going to put numbers on it. So what do you give up now if you go and work in certain industries? And you'll be quite shocked at the numbers. And once you formalize this opportunity cost, it all comes home and it all becomes very clear what you should and shouldn't be doing. Then we're going to actually look at how you do follow the road to success in the industry. So how you actually start off on the road to success. There'll be tens of thousands of applications going in to investment banks, hedge funds, asset managers, and literally everyone's got a 2-1 or a master's, and everyone's in a society. All those CVs go in the bin because there's nothing special about them. And I've been on the other side, and I used to hire the graduates and train them. So I know what to look for, and I know what the banks and the hedge funds want to see. So we're going to show you what you need to be doing over the next couple of years to actually really stand out and get into the industry and start off as successfully as possible. So let's start off with navigating the landscape. This is the first thing you've got to do in any industry. Any industry you go into, you want to apply to go into, you need to know why you're applying. You need to understand the landscape, how the industry works. So in this industry, trading and portfolio management, it's no different. You need to understand the landscape, how it works. You need to know what you're applying for. What we're going to be focusing on is the major players, places where professional traders actually work, because there's different types of professional traders. The vast majority of professional traders work in these two places: investment banks and hedge funds. In your own time, you need to look up the following guys, work out what they do, because that's really the entire finance industry and trading and portfolio management industry. So pension funds, long-only funds, private equity, so non-publicly traded assets, the brokers, so interdealer brokers, they're the guys that trade exclusively with institutions, retail brokers who trade directly with the man on the street, and retail banks who bank with the man on the street. But we're going to focus today, for the purposes of this presentation, where the vast majority of professional traders and portfolio managers work: investment banks and hedge funds. So let's start with investment banks. Who are the clients of the investment bank? Well, they range from blue chips, pension funds, hedge funds, family offices, private equity, high net worth, so what's defined as a sophisticated investor, and retail banks. They've also got a lot of financial interests in their clients as well, so it works on a loop. Their clients who do business with them, they actually invest in quite a lot of them. And these guys don't get up at 5 a.m. and get into the office at 6 and stay up all night working for no reason. Every area of the investment bank wants to make profit. They're public companies, they're answerable to shareholders. This presentation will be up online in about 3 weeks' time, so if you've registered for the event with your email, you'll get an email with the link. You'll be able to look at this in a lot more detail, but essentially what you're looking at is the structure of an investment bank globally. For today, just focus on everything from the middle to the left. So everything from the middle where it says primary market to the left where it says secondary market. So the primary market side is where debt and equity is issued. Clients go to the investment bank and they raise capital in the debt markets and the equities markets. What happens when those assets, the debt and the equity, become publicly available? They're traded on the secondary market side by the traders. And on the secondary market side, the business is split up into agency and proprietary. So there's an agency business and a proprietary business. Like I said, you can look at that in more detail, but that's the most important thing for today, to understand this side of the industry, because that's where traders and portfolio managers work. So once assets become publicly available and publicly traded, the traders and portfolio managers trade them. But what does a guy in an investment bank do? What does a trader at an investment bank actually do? You need to understand this if you're actually going to apply to an investment bank. So let's have a show of hands first. How many people in the next year are going to apply to an investment bank either for an internship or a grad position? Or planning to? Okay. So that's pretty conclusive. At least 90% of you there. How many people are going to apply to hedge funds? Maybe 5 or 6 people in the whole room. Okay. Before we go on and look at investment banks and what traders do there, why don't we just work out the reasons why, very quickly, you're applying to investment banks. What's the reason? Someone shout out a reason why they are applying to investment banks.
High pay.
Sorry?
High pay.
High pay. Let's remember these. So the first one, high pay. Anybody else? An interest in the financial markets. Okay. Anything else?
Hedge funds don't usually provide internships.
Hedge funds don't provide internships. Okay.
Training opportunities.
Training opportunities. Yep, remember that one. That's good. Anything else? We'll come back to these, but just remember them. So what was the first one?
High pay.
High pay. Training opportunities. So there's no opportunities to do there's no training opportunities elsewhere. What was the other one over here? What was the other one over here? Interest in the financial markets. Okay, let's remember those. Let's start at the investment bank then, where you're all going to apply. Trading and portfolio management. So if you're a professional trader at an investment bank, if you're a professional trader at an investment bank, 90% of your time is spent being a market maker. You make markets in the assets that you trade to clients. 10% of your time is spent as a proprietary trader, so using the bank's money to make money. And it's called proprietary trading because it's really everything that the trader does that's proprietary to doing business with clients. So it's going to be pretty important to work out, if you're all applying to investment banks, what the hell a market maker does. Because that's what you'll be doing 90% of the day. If you go there for 10 years, you'll be doing it for 10 years. So you need to know. Market making on the secondary market side is the bread and butter of the business. And it splits up into two areas: agency and risk business. It's the bread and butter of the business because it's the commission business. It's the backbone of all the profit of the company. And I'll explain in more detail why as we go along. It becomes very, very obvious. These days, a typical commission on the secondary market side in equities is 5 basis points. So 100 basis points is 1%. Typical commission is 5 basis points. So if we're looking at an agency example, and by the way, agency is 80% of all market making business these days, we can use this example. It's very, very straightforward. A client, a hedge fund or a pension fund of the bank on the secondary market side decides they want to buy $10 million of Apple at $500 a share. So they want to buy 20,000 shares in Apple. They've got two choices when they call the investment bank. They can either give it to the investment bank to execute on their behalf in the market, where the bank does it with no risk, or they can ask the bank to commit capital, so ask the bank for risk. Agency is when the investment bank takes no risk. They buy it on behalf of the client. Now that can be done over the telephone, or it can be done over the computer. So the client can actually put the order into the order management system, and it goes directly to the investment bank, pops up on the screen of the salesperson. The salesperson clicks send. It goes to the trader. The trader clicks right mouse, send to the computer. The bank hasn't taken any risk. They're buying it on behalf of the client. When it's done over the phone, the dealer at the pension fund or the hedge fund calls the salesperson and says, take an order for 20,000 shares in Apple to buy at 500. The sales trader enters it and sends it to the trader. the trader accepts, right mouses, puts it in the computer. Either way, it goes in the computer. But in this example, let's have a look at the way the business works. In this example, the clients decided to buy $10 million of Apple, 20,000 shares. The bank gets paid 5 basis points for just doing nothing. Whether it's put in the machine by the client directly or done over the telephone, they haven't committed any capital. It's risk-free. What about the risk business? The risk business in market making, that transaction is done slightly differently. This makes up about 20% of all market making. So instead of the order going directly to the bank or via the salesperson, directly to the trader or via the salesperson, and put in a machine, they're going to the salesperson and asking the bank to commit capital. So they ask the trader via the salesperson to sell the 20,000 shares to the client. The trader ends up short 20,000 shares and has to go into the market to buy them back. If the stock goes down, they obviously make money. If the stock goes up, they lose money. Market makers are measured on their ability to retain the commission that the bank is getting paid. So imagine if you're running your business on the trading desk at one of the investment banks, and over the whole year you get paid $50 million commission. The bank gets paid $50 million commission. For you to do that business, to bring that 50 million in, you had to commit capital in at least 20% of the orders. So let's say you lost $10 million doing that. Well, you've got a retention ratio of 80%, which is very good. In this example, the retention ratio is 60%. So a bad retention ratio is 50%, a good one is 75%. Your ability as a market maker is measured on how much commission you retain. So market making, it's what 90% of the time traders are market making at investment banks, not prop trading. This is what you'll be doing the vast majority of your day. That's what you're applying for. It's split up into agency and risk business, but 80% of the time, it's outsourced to a machine. And 20%, the market maker is required to take risk to the client. So we're just doing 80 times 90 here. 72% of the time, a professional trader these days at an investment bank, the day is spent monitoring software. It's spent monitoring algorithms. Because the software, the algorithms are processing agency orders. And they may have lots of these all happening at the same time. So 72% of a trader's time is spent at an investment bank monitoring algorithms. Does that sound sexy? There's no human skill in market making anymore. 10 years ago there was. However, the industry has been in structural decline for over a decade. What you're applying now to is a totally different industry to what it was 10 years ago. What was the typical commission number that we looked at before? Can everyone remember? 5 basis points. What do you think the industry standard was 10, 12 years ago? I wish. Almost. It was around 25 basis points. was industry standard 10, 12 years ago. Now, if commission is the bread and butter of the secondary market side, and it's gone from 25 down to 5, that's down 80%. What do you think's happened to everything at the investment bank? Because everything relies on it. Everything's down 80%. This is the problem that you face now. The other 18% of the time of the market maker, if you think about that trade that we looked at in Apple, where the market maker commits capital and sells the Apple to the client, do you think that trader actually wants to do that trade? Well, it's a catch-22 situation. Because when the client comes in and says, I want to buy $10 million of Apple, 20,000 shares, can you sell them to me at 500? If the guy says no, if the trader says no, 3 seconds later the trade's done at the investment bank around the corner. There's competition still in the industry. Of course there is. So they're kind of forced to do the transaction. They don't really want to do it. They don't want to commit the capital, but they'll do it if, on balance, it's worth doing. So they're kind of forced to do it. So the other 18% of the time, unfortunately, what you'll be doing at an investment bank these days is putting out fires. You'll be unwinding positions that you don't want to have. So 72% of the time, you'll be watching machines trade, making sure they're not screwing anything up. If they screw it up, you do a right mouse, you pull the order out the market. When the machine behaves or wants to behave, you right mouse and put the order back in the market. The other 18% of the time, you're scrambling around to get out of risk that you don't want. That's the job of a market maker. That's 90% of what a trader does at an investment bank. That situation where you've got lots of positions that you don't want to have, that is termed in the industry as the negative selection portfolio. Those positions have been negatively selected. You didn't really want to have them. You got given them by the clients. And now you're spending your time trying to get out of them.